Welcome to the Bear Ventures podcast, where we open the book on venture capital and give you a seat at the table. I'm joined today by Nick Dolik, a good friend and senior vice president of the venture banking group at Signature Bank. Good sir, it's good to have you here today.
Yeah, thanks for having me on.
Now, I think, and I mentioned this earlier, this is probably one of the only episodes where it's a debt provider for startups. So not just myself, but I speak for everyone. We're excited to hear more.
Yeah, it's fun stuff. Excited to talk about it.
Awesome. Well, Nick, I want to quickly just start with your background. You've done a lot. And so rather than me butcher it, it'd be great if you could share kind of where you came from and where you are now.
Sure. So grew up in Michigan, and then like a lot of my friends who moved to New York ended up in finance. So I started on the credit side, mostly at Goldman. And to go way back, my family is Armenian. My parents are first generation, bunch of scrappy entrepreneurs in our family. So I wanted to go from big bank where I could learn a ton out of school to startups. So I found a startup that I really liked that was serving other startups. I ended up leading growth there. And then after we sold it, fortunately started to be able to invest in startups a little bit. And that's what led me to venture debt and Signature. So, in kind of a roundabout way, started in credit at Goldman, and now I'm back in credit. So it's been a fun ride, and it's my last stop in terms of I want to be helping startups with capital for kind of the rest of my life, and fortunately able to do that now.
Yeah, no, I know you've been from a prior life very active in the early stage venture side, and so when I heard about your transition onto the debt side, it's exciting as most don't always talk about or even know about these alternative sources of financing. So could you give us a bit of a overview of what is out there, right? Everyone thinks about traditional priced equity rounds. Some will talk about notes, but what else is really out there in the world of alternative financing for startups?
Sure. And don't feel badly, because I was the same way. And that's kind of how I sought out to get into this. I just felt like coming from seeing my dad build a tech company out of our basement, never raised money. I was fascinated by other ways you can fund a company and win VC and get in your company, and it might not, and the periods of when it could, and then you get in the rabbit hole of different types of debt. So I'm happy to go through kind of certain pockets, and I'm sure I'll miss some. But as you think about funding a company this is on the non-VC side, there's a couple of different ways that people kind of bucket into the broad of debt. What I do specifically is senior secured lending from a bank. So that's a certain pocket of debt that typically comes with lower costs, but there's other things related to that. So there's us at Signature Bank, which I can go into later. There's other types of things, such as a lot of it has popped up now in revenue-based financing. So a company will have a certain amount of revenue, and a lender will come to them and give them a certain amount of that up front, and then they take a percentage every month of that top line until they're paid back a certain return. So that's another way of non-dilutive capital. There's some that popped up like a Cap Chase or a Pipe and some of these other businesses that will look at recurring revenue. And instead of saying, hey, I have X amount of monthly recurring revenue, they'll multiply that out and give you your annual revenue up front. And they'll take a certain clip of it, and that can be less dilutive for companies. But, I think what people think most of debt is, from our world of banks, is term loans and lines of credit. And a term loan, you can think of it like, almost like a mortgage, but there's kind of a delayed payment of that principal. So usually 12 to 24 months of delayed payment there. But it's when you're getting a lump sum of money up front. Say you're getting a $5 million term loan, you would have access to that up front in most cases. And then you're paying that down over 3 to 5 years. The other common structure in bank debt world to startups is a line of credit. So you can think of it like your credit card. It's a certain availability, and it's usually based on a multiple of your recurring revenue if you're a SaaS business, or the other borrowing basis tied to it if you're not, or even if you are software businesses. It depends on the maturity levels of the companies, and I can also talk about this more later. But a lot of what we look at when all we do is back companies that have been funded by VC. We're looking a lot for these companies have from that, and we lend based on a component of that. So that was long-winded.
Now, I think that's helpful to go over in terms of the landscape. And I think the key there was non-dilutive capital. what you often see, for those who this might be fairly new to, is a high growth business where, you need the capital now to continue to grow or enhance that growth, but you don't necessarily want to raise a price round now where you were, by
Yep.
essence of doing that, owning less of the business. And so it's groups like Nick's at Signature Bank, which will come in, give you debt based on, either a senior secured lending facility, or something like you mentioned before, revenue-based lending, and not take an equity piece like you would see from a normal priced round, or a traditional priced round, if you will. And so, what kind of businesses would you say, are typical, or where do you start looking at companies? Is there a certain, scale by way of revenue, or customers, or certain industries you prefer or stay away from?
Yep. Another good question. The short answer is the key trigger for us is that they have VC backing or growth equity backing. So institutional capital has funded the company. That's kind of like the first trigger for us in terms of bank debt, in terms of eligibility for us. I want to caveat that in other places have different strategies. Usually as a regulated bank, competitors of ours also like to see things that are similar, but there are alternatives. And that's why other things exist, such as venture debt funds, such as, the Cap Chase, the Pipes of the world, the Clear Banks of the world, factoring firms that will take your invoices and do that. But yeah, our key trigger is VC backed. And what we like to see is similar to, there's different strategy around debt. Obviously, it's not trying to bet on, 20 companies and hope one goes well. It's very downside protected. So we want to see that there's equity investors that are supportive of the business as a key front item. And then it obviously is easier to lend to companies with recurring revenue, so SaaS, or predictable revenues, but we're generalists across. Say it's tech, but it can, based on where the equity on the VC side is going, we tend to trend with that and follow where equity investors are bringing a lot of support. And a lot of it's based on relationships of the funds that are supporting these companies with equity. That's a key part of our underwriting.
Yeah, and I assume that for a lot of these high growth, high performing businesses, the equity or earlier equity investors want nothing more than to put more capital to work in those companies as the winners of their portfolio. So do you ever see, just curious, any kind of pushback for these companies taking on this debt versus raising another round?
Yeah, and this is someone who's newer in the debt field as well. But when I was on the equity side, I was sometimes wary about it. I was like, hey, debt, people think of debt in scary ways, given other things on the personal debt side that's going around in the world that's concerning. But no, I think since COVID, it's interesting. Since COVID has happened, I think a lot more boards and management teams are thinking about debt in a way that, hey, why don't we put it in place, even if we're not going to use it, for optionality, given where rates are and how cheap it is for us. And this is different for other providers, like I've kind of outlined, but for us, we don't force a draw of the debt because we're a bank, and we also are going to be taking full or majority as the primary bank when we're funding a company. So we don't need to force a draw in order to make it cost effective to kind of allocate that funds that we're committed to on the lending side. So boards and companies have looked at it of, hey, this is really cheap money that is either non-dilutive or very minimally dilutive. If in typical times we're taking success fees or warrants, which I can explain, but they look at it as, hey, we're getting extra capital, we're letting the company dilute themselves less, and it's cheap and we don't need to use it. So why not do it? I think it's become, and this is someone who's extremely biased, obviously, but it has become something that I think people are thinking more about. And we've seen it in terms of demand and how competitive this market has gotten over the years. And the team I work with has been doing this for a long time, and they built and sold Square One Bank, which was a major competitor to SVB for a long time, and came over to Signature to build this. So it's something that they've seen evolve, and I'd say it's more competitive than ever right now to help companies with this, given entrepreneurs now realize they can raise money without giving up 20% of the company every time they raise money. But we're not trying to replace VC. We're actually very closely aligned with VCs, and we complement them because we can prevent them from getting diluted and also help them raise higher valuations in later rounds on the companies they're backing, given our main function is really extending runway and providing optionality there for those companies.
Yeah, it's an interesting balance where we're at a time that valuations on a multiple standpoint are higher than ever. And so
Yep.
you've got founders that are extremely excited about, I'm just going to keep raising and continue to get capital in now and to your point, dilute myself less. And there are these tools now, like you're offering here at Signature Bank, where it is non-dilutive capital as a whole, and it's a debt product that they might not be fully comfortable with, but maybe shy away from in the near term because of where multiples are. Are you running into that issue a lot where you build a relationship, you go after a company, you offer them a term sheet for debt, but just based on where the market is, it becomes difficult to compete?
Yeah, I think it's been interesting to see some of these companies are just like, hey, we're getting such a good round offered here, even when they don't need the money, that they're like, we're just going to take it. And in some cases, they would just bank with us and revisit the loan later, or they say, hey, let's talk about this another time. I think given they see how fast these rounds are happening now and how much valuations can move just based on, if say they're growing 50% a year, which a lot of these software companies are growing that or more, they see the power of, hey, if I can get an extra 3 to 12 months of runway, I can boost it, and in a cheap way with venture debt or other solutions, I can really boost my valuation that much more and get that much more money, or get just better terms in general, regardless of the money they want to raise. So
Mhm.
I think that's been a powerful talking point. And so landscape, there's a ton of capital. VC funds are larger than ever. They need to deploy those over however many years they have agreed with their LPs, and I think that has played a part of some of the boost and how competitive it's gotten in terms of anyone providing capital to these companies, regardless of debt or equity.
Yeah, and are you seeing, traditionally it's been the bigger banks and groups like yourself that, are able to provide this type of a service, but are you seeing other entrants in this space, other private investors trying to come in? What do you see evolving over the last couple of years?
Yeah, and I think this is a good point for me to kind of backtrack on different types. So it's interesting because there's not only different types, but there's different strategies within the groups who do broadly bucketed as debt. So you look at an us, so a bank lender to startups. There is certain reasons that a company would want to optimize to work with us versus certain reasons they'd want to optimize to work with a pipe or a cap chase of the world who's doing like the quick, next day funding type services. So what we're doing is, we're $100 billion bank. We can lend, we kind of advertise 1 to 30 million per deal, upwards like 1 to 50 is kind of the range we play at. It can have some no cov if it's really early stage company that's backed by some really good investors, but typically there's covenants around it, and those are basic rules around making sure that the company is hitting expectations they have set with the board.
Mhm.
There's reporting around it and other things. So I like to think what we do is, if you want the cheapest form of debt you can get from scalable partners, and in our case we're highly focused on long-term relationships, and we're a single point of contact model, and we're not focused on eating the entire market and working with every company. We kind of lean in and want to build a nice portfolio of companies that we think we can grow with, and we spend all our time with. So it's not like I have a deal, I throw it over the fence to credit, hope that I can do a deal, and then I kind of pass it through after they sign with us and go through. We're actually managing our own portfolios, and we kind of grow that way with them from a single point of contact. So if you want something like that, you go to an us. If you want someone who's just going to give you kind of a spit out a term sheet and a brand name, there's other players that it's a commoditized market in terms of what we do. It's more the model of what you get. So if you want, an SVB does this very well. They've been doing it for a long time. They want to be good with backing a lot of the market, and they're set up in a way that caters to that. So they have their business development groups, they have their portfolio management groups, they have their credit groups, and they have other styles that can scale that portfolio. And there's nothing wrong with that. It's just a different flavor. So if you want that, you can go that way. And then there's other bank competitors. And then you kind of go more broadly outside of that. And we can talk about a cap chase or a pipe or a clear bank. And obviously a clear bank is more catered towards e-com. A pipe or cap chase is more catered towards SaaS.
Mm.
Regardless of what they're catered to, their function is, hey, if you want to work with a Nick or an SVB or other venture debt players, if you don't want to go through the process of, doing Signature Bank's DD process, or, Comerica Bank's or JP Morgan's DD process, which can be similar to like you're raising another equity round, like you're leading, you're running a Series A or Series B. It's not like it's I mean, these days with equity, it's a little crazy, but it's not like it's a, hey, like what you're doing, here's money. There's a process there. And then after, there's also meetings and there's reporting and there's board requirements. There's expectations there. So it's just a different flavor. Whereas these other companies that are doing it, it's more expensive capital. But with that, and more expensive is in like, I say high single digits to mid-teens, maybe higher in some cases. So significantly higher than where we're at. But you're getting it maybe in a day or two, because what they're doing is they're plugging in and they're looking at your numbers and they're using tech to identify companies that they want to fund, and they can do it faster. So if you don't really care about the cost of capital, and like I said, it's all what you're optimizing for. So if you're optimizing for quick, easy, minimal reporting, no covenants around it, no warrants of success fees, I don't care if they cap it out a certain amount because they can only lend up to $5 million, whatever it is. And like, there is a world in which that makes a ton of sense for a lot of companies. And then you can go to factoring, where factoring is basically a company just buying an invoice. So media companies, for example, have multi-million dollar a year contracts with big enterprises. Instead of waiting 90 days or 120 days for their large customer to pay them that $1 million deal, they can get maybe, $900K tomorrow from a factoring firm, and that firm will make the spread on that because they're fronting that capital. So that's another solution. And there's a lot of new ones popping up, but I'd say between VC, banks, factoring, the alternative financing of the world that I kind of mentioned before, that are more tech enabled, and then revenue-based financing, like those are kind of the buckets you look at. And my goal is really just to be, a partner to entrepreneurs to kind of decipher when it might make sense and when it might not. And I think that's why we're so focused at Signature Bank about only working with a handful of companies versus trying to work with every company, because we know that what we do and bank debt in general is not always the best fit for what you need for your business right now. But we do think it's an important piece for a lot of types of businesses we're trying to fund. So that's kind of what we lean in on. And we're pretty quick to tell a company, hey, go talk to XYZ if it's not us. So that's kind of the whole role of, being a puzzle piece within what I like to think of as funding companies with VC and debt.
Yeah, I think that honesty piece there, because it really isn't for every company, and we can go through
Yeah.
the myriad of reasons of why, but for you to understand that and be open and honest with them, to tell them that this might not be a fit, and we've talked about examples of that in the past. I think that's a great approach, and it's one of the reasons you guys have been around for so long, and it really isn't one size fits all. There is there's always a case where I need money now. Maybe signature is not going to be fast enough, but you potentially might have a higher rate, or you might not be able to go the debt route at all. That's definitely interesting to know.
Yeah. And I just add, sometimes it's the opposite. Sometimes they say, hey, I know I don't need this. This is why. And you can kind of say, hey, have you thought about this and that? And it actually ends up being something they do want to work with you on it. So it's been fun to kind of just talk to more entrepreneurs about this who are moving really, really fast, and they're building exciting companies. And we can just kind of be a helpful partner on helping them identify when something like this might make sense or when it might not. So I think it's a good point that you made.
Yeah, and thinking debt versus equity raise, a lot of times in equity round, there's going to be a more strategic involvement from the investor, right? Whether it's board seats or being an advisor to the company, or aiding the founders with more customers, or whatever it may be for that specific case. Do you get involved on the debt side in any capacity with these founders?
Yeah, so I'd say it's, for us, and this is specifically for what we're building at Signature Bank, I like to, my word is as appropriate, in terms of getting involved, helping the company like a board member would. I'd say we are involved very closely with the board and the management team on monthly reporting and understanding where the business is. And we're constantly checking up with the management team and the board members that we're working with to get pulse updates on the business and how everything's going and where else we can help. We're very much in this as partners together, because they all work very closely to ensure the success of the company. So I use as appropriate because there are certain touch points where we're a regulated bank. We have certain reporting requirements and processes around it, like that monthly reporting. But we also want to be helpful partners to these companies like their VCs would be. So to the extent that companies want our help in that front, whether it's introducing potential leads to their next rounds, whether it's looking at people they can hire, whether it's helping with vendors that they're looking at for, marketing, insurance, payroll. Like I try to be, and our team tries to be, a really helpful piece around that you can leverage your bank and the person lending you versus like, hey, I don't even know who I bank with. It's a checking account and we have a line of credit. Like, there's no relationship there. I think I try to stress that as appropriate as you want it, we're really here to help. And like, this is all we do. All we do is fund companies and investors. And that's kind of our role in terms of the functions of our main products. But within that, we try to be kind of helpful partners in the ecosystem to everyone supporting these companies, not just the VCs.
Yeah, no, that's very fair. And you as a debt investor, and we're also at one time an equity investor, you now look at companies through a very different lens than you once may have. I'd be very curious to hear your thoughts on what is going on in the market now. So, most people we talk to, that are equity investors will, give you their thoughts on, valuations now and where things are going, and, do they think it makes sense? Curious your thoughts on, what is happening right now and why, and where you think we're headed, right? 6, 12, 18 plus months and beyond, what do you think is going on?
Yep. So obviously just one person's opinion.
It's a tough question, and it's a very loaded question. So
it'll be fun to look back on this to see how off I was. But no, my thoughts are this, and it's pretty it's not that much different than a lot of other people, but I think that there's components of a lot more money in the system. And in terms of our market, there's a lot more venture dollars at the funds. Like you're seeing oversized VC funds. There's multi-billion-dollar funds everywhere now, and that's just one piece of it. There's also different types of people now investing in venture. There's endowments seeing record returns on their venture allocations, so maybe they're upping those. There's just a lot of reasons that the dollars going into venture have grown, and I think at the same time, we're only focused on venture-backed companies, but I mentioned some of the other players that can fund these companies. There's other people who will fund companies that might not be the VC growth equity backed companies. Hey, I don't need to be a binary outcome of a VC backed company and I'm going boom or bust. So I'm going for multi-billion-dollar company or nothing. There's more companies that are taking a different path, which means that there's less for us and VCs that have these giant funds to invest in. So long story short, there's less deals that qualify to return a fund multi-billion-dollar in size, which means that the funds that are that size need to really lean in when they see one that could be that profile. So with less deals and bigger funds, it's created this environment that the funding rates are just rapid because they have to deploy these at the same time as well. There's also less of them. I mean, I still think that there's a huge market for these funds, but you are seeing a squeeze of that. Like you're seeing the quote unquote best in breed companies in venture getting the most money, and they can raise on demand because of that need to deploy, and also the less deals for these companies to look at, justify of like, hey, this can be a fund returning investment for us. Because if it's not, then they have to pass. And so I think that was kind of all over the place in some ways, but I think that's a big part of what's happening in terms of valuation boost, the size of funding rounds, I think is, stuff like that. And there's other players like us who are coming in with a different lens that people know more about. This isn't something new that us and our group have been doing. Us and a handful of others have been doing this for a really long time. But I do think that groups like ours elsewhere at other banks are thinking a lot more about this and trying to jump in. And I think it'll be interesting to see how many actually stick with it for years and years to come, even if the market's up and down. And I think it's been refreshing for us to see a lot of the equity investors we work with really, digging their feet in during COVID with really tough times with some businesses. And I think wherever the market is going, I mean, if there is pullbacks, it'll be interesting to see kind of who sticks around and who is kind of pulling back in terms of their appetite for this market.
Yeah, from the investor side, for the senior secured piece, which is what you guys offer as debt providers, is a very different risk profile than what an equity investor would see or go after, and as a result, a different return profile. But to your point, I think based on where we are in and I'm no genie, but in a cycle, let's just say, or whenever it ends up hitting, it is a very different view on the world being a debt holder versus an equity holder, and the
Yep.
way you interact with those businesses. And as you have been, through COVID, there is some difference there as well. But that's
Yep.
certainly interesting to hear your thoughts.
Yep.
I was just saying, I'm curious, as an investor in a venture fund, right, you can get access to or exposure to the upside of, an equity investor. Is there a way for investors to, get exposure to a debt product? So, can you invest into something to, diversify away from just being an LP in a venture equity fund, but also be in a venture debt fund?
Yeah, I think there are, they're called BDCs, public companies, that
Mhm.
do this, and they're what we think of as, and we partner with a lot of them. So you can think of them as, um, they can be coming in directly lending the companies, obviously from their quote unquote senior, or they come in below us as junior debt, and we'll partner with them. And they usually have a more appetite to lend more dollars based on whether it's a multiple revenue, or whether it's just an appetite based on equity raise, or capital intensive pieces of the business. They can lend more dollars. They'll be more expensive, but there is markets for that to invest in there. And there are other platforms that are popping up that are like a Yield Street and other platforms that want to offer exposure to. They're just seeing the resilience of these software businesses. Like I think we see it in the public markets with some of these SaaS stocks, just based on like the net retention that they can have in ups and downs to smoothen out volatility in the market. I think it's been really interesting to see that grow. But for us, we're a bank that we lend off. Signature is $100 billion bank, and we have assets to lend that way. So it's not like you can get exposure to that in that front. And I think I wanted to backtrack on the in terms of how we think about ups and downs in the market. I think that's a big reason, and I'm seeing it on the equity side too. And you've seen it with firms that are just very, like a benchmark, for example, that really sticks to what they do. I think this is a time in which we and others really want to be highly focused on the companies we're backing, not just trying to do as many deals as we can in the environment. I think it's more important now than ever to try not to reach, if you feel like a deal is just getting a little bit crazy. But I think it can be hard, especially for a VC fund that needs to deploy this capital and has requirements with their LPs. And similar for debt funds or these other alternative lenders, they have a high cost of capital, which is why they have to force a draw. Or as a VC, they have to deploy this capital. Whereas us, like we don't force a draw because we have low cost deposits being a bank, and our debt is cheaper and it isn't forced draw, which has made it attractive. It'll be interesting to see how everything plays out. But I am cautiously optimistic about the market continuing to grow and just tech in general continuing to grow. Given I think COVID has really pulled a lot of things forward that we're backing, and I think you're seeing the VC dollars go into a lot of these markets.
Yeah, I think many are watching, kind of the same way you are, and I look forward to a follow-up here where we get to see how
Yeah,
things
it'll be fun.
set
We'll
up.
bring it back. Yeah.
No, 100%. And it is a different view, and I'm glad you bring that up, where, a lot of venture funds do have to deploy the capital. Um, they could always not call all of it and have a tougher time raising the next fund, as no investor wants a fund that's, called only 50% deployed, at maturity. But it is a very different type of pool that you work out of, especially coming from, Signature Bank, as such a large group with the balance sheet. One thing that before I let you go, I always like to ask people, and just get your view on is, what does the future hold for you at Signature Bank? What do you view as the next phase of venture debt or offerings, or ways to continue to evolve with the market? Always curious to see, not just where groups like yours are today, but what is the plan in the future?
Yeah, I think we want to keep doing what we kind of came to Signature to build, and that's just supporting entrepreneurs and everyone supporting them. So that's primarily for us. entrepreneurs and then their VCs and growth equity firms that are funding them. But I think within that and through all of it, we want to just be known as a really good partner to the ecosystem, and primarily through the venture debt and the banking we provide, but also just as, individuals and a team in this market that we're really passionate about and have no plan to pull back from for years to come. So we're in almost year 3 of our group at Signature. We're really excited about what we're building, and we've been fortunate to grow with this market. And some of that can be argued as just given how much this venture market is kind of blown up in the last couple of years in a good way. But yeah, we're going to stay humble and keep working really hard to grow this portfolio and just be really good partners to the startup ecosystem.
Yeah, and I completely believe you. I know you've been helpful to me on many accounts as well. So, I
try.
That, of course, and I look forward to that continuing. But no, Nick, it's been great to have you on the show and share a different perspective as it relates to venture debt. There's not, too many folks out there compared to the equity side that do it. And so it's great to get that kind of perspective for our listeners. For those of you that are tuned in today, please do follow us, Bear Ventures on LinkedIn, and myself, Samir Vig, as well, to be updated of future episodes that come out. And until next time, take care.
Thanks.